Hello traders, this is PSK. Today is Wednesday, January 12th, 2022. And in this video, I'm going to talk about the things the market cares about. What is a headwind? What is a tailwind? What is the market really trying to watch, and what does it care about as far as on a macro level? So real quick disclaimer, this video is for educational, informational purposes only. This is not any buy or sell recommendations. I'm not a licensed broker, dealer, or investment advisor. Please consult a professional for any kind of investment trading advice. So let's jump into kind of what the market cares about. So if you look at over the past, just say 30 to 40 years of what has caused major market crashes, what has caused major market rallies, and what does the market really care about? And the reason I bring this up today was because today, the big focus for the markets was the CPI data, right? Inflation. What is the inflation data telling us? What is the consumer price index telling us month to month, year over year? And as you can see by some of the data on the screen, that for December, the month over month, the forecast was around 0.4%. In November, it was actually a 0.8%, so they're looking for almost a 50% reduction month over month. We came in around 0.5%, so a little bit higher than expected, but definitely lower than the previous month. Okay, as far as year over year, we were at a 6.8 in November. They were forecasting around 7. We came in at 7, so right in line. Overall, the numbers were a little hotter than expected if you look at all the numbers combined, but more or less right in line with what was expecting. So why does the market care about this? Well, if you look back, and let's just kind of take a look back at, let's look at a weekly chart here. So if you look through the history of the market, you look through time and you look through all these big pullbacks, these corrections, these crashes, what has caused that? And every year, every month, every quarter, even day to day, there are what we would call headwinds for the market, and there is what we call tailwinds for the market. Now, in my opinion, the number one thing the market always cares about and will always care about is monetary policy, the Federal Reserve, because the Federal Reserve provides liquidity to the market. It provides short-term borrowing for the banks. It is what we would consider the backstop or the holder of the keys per se to the market as far as should it correct, should the economy start to fall, what is going to support the market and stay up, right? Who's going to come in and buy the dip, right? If things get really bad, who's going to pump money into the system? And that's going to be the Federal Reserve. And it's not just in the US, it's central banks across the world. And so in my opinion, the number one thing that controls and moves markets is monetary policy. Number two is going to be macroeconomic policy mixed in with some political policy, right? It's why the market likes to see, at least as far as the US markets, it likes to see a mixed House and Senate. At that point, it really is irrelevant whether it's a Democrat or Republican in the White House. It basically means gridlock in Washington. It means one political party is not running rickshaw over legal legislation or over economic policy, and things can be kind of, they have to have bipartisan support in a way, right, to get things done. They have to work together. Neither party is in control. And that's what the market likes, versus if one side is in control over the other, it can definitely skew the markets or certain stocks, certain sectors in a specific way. But the one of the reasons I bring it up today about the CPI is because if you pay attention to what moves the markets, it's constantly fluctuating depending on what's going on in the economy and what's going on with monetary policy. So right now with inflation, it has the Fed on the back step, basically on the move. The Fed can no longer just sit by like it has for almost the past 2 years and keep interest rates low as well as continue to provide liquidity for the market. The economy, the economic numbers, the employment numbers, some of the other macro data has come back to where the economy is sound and stable, but inflation is at an almost 42-year high, right? We haven't seen inflation like this since the 80s. So the one way that the Fed can counter that is by raising rates. And that is essentially what they think will help bring down inflation or get inflation under control. But if you think about the market and what the market cares about, there's always a headwind for the market and there's always a tailwind. Right now, inflation is a headwind. So going into today, this CPI was the most important number, right? And it changes month to month, quarter to quarter, year to year. For the prior few quarters, up until the last, I would say 2 quarters, it's been all about the non-farm payroll number. If you think about what was going on in 2021, what was the macro data piece the market cared about the most? It was jobs. Is the economy recovering? That non-farm payroll at the first Friday of every month was what the market cared about the most. And if you go all the way back into the crash of 2020 where the pandemic started, you know, this crash was caused by the pandemic, right? It was caused by global shutdown. It was caused by uncertainty. You know, what kind of virus was this going to be? Was this going to be a global killer? Was it going to be just the flu? You know, the market didn't know. So it panicked and sold off risk until it kind of got its arms around what the virus was doing, what it looked like, you know, what was the death rate, was the mortality rate, and then it kind of was able to adjust and rebound, as you can see. Now, for 2021, and in 2022, the end of 2021 into 2022, it's been about inflation. It's been that CPI data point. So if you know that the market is going to respond to this macro data going into that event, you should treat that like earnings. You should treat it like a major catalyst event, meaning you should be positioned accordingly. You should know what sectors are hot, what sectors are lagging, right? What's leading, what's lagging, what sectors are going to be impacted the most, where is the rotation, and what is your exposure going into that print, as well as is the market, quote, air quotes here, priced it in accordingly, right? And I'll talk about what that means in my definition here in a minute. But the market is always concerned about one data point, and that data point changes all the time. And right now it's CPI. For most of 2021, it was payroll. It was what is unemployment doing? What are continuing claims doing? And then what was that non-farm payroll? Were people getting their jobs back? Were they going back to work, right? In 2020, it was all COVID headlines. It was vaccine headlines. It was the stimulus from both the Fed and the government, right? Those were the things the market cared about. In 2020, the market didn't care about inflation. It didn't care about CPI. It didn't care about NFP. Those were irrelevant to the market at that point. And the reason I bring this up is because you constantly just need to pay attention to what the market is reacting to and what data point the market cares about the most. Now, if inflation comes down over the next 6-12 months, the market will care less about CPI, right? It'll shift to some other data point. And even going back to pre-pandemic levels, if you go back to 2019, what did the market care about in 2019? Well, first of all, it had to deal with an upcoming election. That was one thing that it cared about. So it had to deal with policy. But from somewhere in 2018 through 2019, the market cared about tariff wars, right? It cared about the U.S.-China tariff war, right? Every negative tariff headline, right? Probably, which is some of these pullbacks you're seeing, along with some seasonality in here, earnings, things like that. But it cared about the tariff war, right? There's always something the market cares about, because at this point, unemployment was at a historic low, right? GDP was through the roof, right? All the numbers, the economic numbers were looking great. CPI wasn't even on the Doppler radar, right? As far as the market is concerned. There's always headwinds, there's always tailwinds to the market. And some of that is going to be Fed related, quantitative easing, quantitative tightening, where are interest rates. The other thing the market cared about was during this 2-year span, we had what they call the yield curve inversion, where the yield curve, where you had short-term rates rising, low-term actually getting above, they were higher than long-term, right? That's not what the market likes to see. And that's when the yield curve inverts, creates a little panic in the market, right? There's always a headwind. But as far as if should you listen to CNBC, should you listen to financial media, the one thing you got to understand about financial media, it's their job to come up with a daily headline, right? The market went up because of this headline. The market went down because of this headline. When in reality, most of the time, it really has nothing to do with any of that, right? Omicron is the big thing that's going on right now as far as financial media is concerned. But if you just look at how the market trades, when we come into macro data points, when we come into Fed days, it will tell you what it cares about. It will tell you what the headwind is. And right now it's inflation, it's CPI, it's the Fed raising rates. So does the market have that priced in? Now, to answer that question, I think it has to depend on what your definition of priced in is. And when I think about does the market have it priced in? I think of, has the market rotated into specific sectors? Has it moved its portfolio around heading into that event from the prior event? And to me, the answer is yes. So coming into today, as long as the numbers were in line or down, the market could react positively, which is what we saw for the most part. Because the market has rotated into those inflation type sectors. So for example, energy has been red hot, right? The market has been rotating into energy to kind of deal with some of this inflation and kind of rebound some of these sectors, these names that have been really hit hard from 2020 that never rebound, right? Some other ones that they've rotated into are banks. Right, the financials have taken off a little bit here, both on a big bank level and both on the regional bank level. They've shown some strength. Consumer staples were strong for a long time, right? And consumer discretionary, right? They were rocketing to the upside. You're right. So the market has become a little more defensive, where value is outpacing growth in specific areas. Now, a great example of this. When you say, has the market priced it in? Well, that's what the market's been doing for the past couple months. It's been pricing in inflation. So you've seen these super high growth names, right? Stuff that has high multiples, high PE ratios, maybe little or no actual revenues, right? They've taken these stocks to the absolute woodshed, right? UPST was up at 400 in October. The stock is now down at 100, right? It's down over 70%, right? 80% off the highs. That's insane to think about. But that is the market repricing in the new macro catalyst, which is inflation, right? Yields are going up. If you look at the 10-year, right? The 10-year yield has been going up. Even if you just look at it from a monthly perspective, from December, from around Christmas, yields started rising. That's bad for high growth names, okay? It makes their margins shrink, right? Margins shrink, profits shrink. It's harder to make money. So the market doesn't want to be overly positioned, overly exposed in those names. So they have to sell those high growth names, and they have to buy other things. So they've been buying energy. They've even been buying some foreign markets. You're seeing Mexico markets. You're seeing European markets catch a nice bounce here, while even some of these high growth names continue to move lower or drift sideways. So this is just one of the macro things the market cares about. And as long as the market keeps reacting to CPI and makes these big volatile moves, then you know that's important to the markets. Now, for example, the non-farm payroll number came out on Friday and it was a big miss, right? Now, what does that mean as far as a miss? Well, it means the Fed may have to do specific things, may have to change their path, may have to do something else other than what they were originally stating, right? And that's what the importance of the Fed is. All this macro data determines what the Fed can and cannot do or how they should react. That's important to markets. Again, going back to that monetary policy stance, right? So this is all tied together. It's all in the markets. Is it the reason the market moves up and down every day because of, because CNBC says so? No, not necessarily. Is it important to know? Yes, because it's going to determine how you trade, where you're invested, what you're swinging, where money's rotating to. But at the same time, it's good to know when those catalysts are coming up. Like we had CPI going into today. So if you caught the rebound on Monday afternoon when we bottomed out midday and then rallied into the close, had a nice bounce day follow through on Tuesday, and then today was a nice little bit of a gap up, and then with the inflation numbers, we saw a strong push. And we've actually reclaimed some levels to the upside. We've now went from all the way down, back testing some support near the 100 EMA, back over the 50-day moving average, and back above some major resistance right around 47.07 to 47.10. So that's got to be the level the market holds now if we're going to see continuation. Otherwise, we could fall right back and break right back down, maybe even go back down and retest this 46.61 level. But the market seems to be okay with the data and positioned for the inflation as it stands now. Now, if the Fed is signaling 3 rate hikes and we get 3 rate hikes, then the market should be comfortable with that. And that's another thing to think about when you hear the term priced in. Is the market rotated into the areas it wants to be? And are the numbers in line with expectations? Has the market mentally digested that information and it's comfortable with it moving forward? Because all that's going to impact earnings, right? Future growth. They always say the market is a forward-looking mechanism, 12, 16 months, 18 months. But anybody who's been doing this long enough knows that can change real quickly. If you start having earnings misses, if you start having inflation not come down, there's certain things, and this is why we've seen this volatility. And this volatility will probably continue for a while, if I had to guess. Because of inflation staying high, you're seeing shelves empty at stores because supply chain issues. I mean, it's just a spiraling web right now, a circle of one thing leads to another. It's just like dominoes. It's like, okay, well, people get sick from Omicron, so they can't go to work. Well, if they can't go to work, trucks don't get shipped. If trucks don't get shipped, supplies don't move, stores are empty. It's just this vicious cycle. And until that stops and it can get caught back up, this is how it's going to be for a while. So those are some of the things I wanted to talk about in the video. What's important to the market, what the market cares about. I hope that helps. Maybe hopefully a couple light bulbs went off. Again, this is just my interpretation, how I view things. But to me, it's always the market will tell you what is the headwind and then what's a tailwind. And right now, kind of a tailwind for the market is that the economy is back to full employment. Businesses are open. We have strong demand. We just lack supply. So, there are certain tailwinds, but at the same time, the headwinds are right now inflation, and that's probably going to change in the next 6 to 12 months, right? If inflation comes down, it's going to be the next thing, right? So when it comes to these big macro data points, look for the one the market reacts to the most. And when the market stops reacting to that headline, it means it's not that important anymore, right? There was a point where the market stopped reacting to COVID headlines. There was a point where it had an initial pullback off the Delta variant, then it stopped reacting to Delta. We saw the same thing with Omicron, right? I think this might have been the Omicron pullback here. We saw the Omicron pullback, the market digested it, we made new highs. Now we're dealing with, this is just the new year stuff going on. But hope that helps. Hope you enjoyed the video. If you did, hit that like button. Make sure you subscribe to my channel. This is where we're going to be posting more videos for the future. And we'll talk to you next time.